This video is brought to you by the Moo Investing app. Use the link in the description to get 5 free stocks. There's no need leaving free money on the table. Now, what we all been waiting for, this is technical analysis lesson 2. At this point in time, you should have already taken lesson 1 so you can understand the fundamentals like a beast, like a big dog. Now, let's go on to moving averages. We're going to talk about the simple moving average, and we're going to talk about the exponential moving averages, so then you can learn one of the strategies that you've been hearing about often, which is the 1348 exponential moving average, right? You want to know about that cross and how to trade and identify strength or weakness. Now, let's get it going. I got your back, Discord family. This is at no additional cost to you. You already know what time it is. We appreciate you for being a part of the family, and we're always going to provide value just like this. Now, let's get it going. Without further ado, check it out. We got technical analysis, lesson 2, and what is it about? Moving averages. And you can see where we're going with this, moving averages, and then how to set up your account the same way that I have mine set up. And then we're going to go to simple moving average, and then the green one, EMA. We're going to learn what that is, and then we're going to learn about the trading for pro tips, right? So pro tips, how to actually trade with these moving averages. And then when you're done with this, I want you to go to the class question section in the Discord. And again, let's get it going and let's make it happen. Let's win together, family. You ready? So technical analysis lesson number 2, moving averages. Whenever you see on the stock market, you see these lines on these charts. We talked about what candles are in lesson 1. Now, when candles move, they show you the stock price moving up and down, and sometimes it's all over the place. But you can take a moving average to get the average. Is on average in the last 15 candles, has this thing been in an uptrend or a downtrend, right? It smooths it out. In the last 50 periods, or 50 candles in this case, has the average been going up or going down? So then these are the average. Let's go to the definition, a simple definition. It's an indicator, right? Like, for example, the MACD or the RSI or all these other kind of things that you may have heard of in the past. This is an indicator that smooths out the trend by filtering out the noise from fluctuations. So when you look back and you see the stock price moving, right, and you catch it, oh, this is an uptrend, and then you see it come down here, like maybe this red candle over here, you follow the mouse, and you're saying, oh, is it a downtrend now? You look at the moving average and you can see that it's still an uptrend, still going. But let's keep it going. Let's look at an example. So take a look at this 200 period moving average. You'll see that the moving average is showing you that at this point that the arrow's pointing at, it's in a downtrend, right? You see some of the arrows going, or the candles going down, and then they're coming back up. But then you ask yourself, is this a downtrend overall? And then you say, you know what? Look at the moving average. And if you see this line pointing down, then it's showing you that in the last 200 periods, or 200 candles in this case, it could be 200 days, it could be 200 minutes, whatever. But notice this trend line told you that you were in a downtrend. That's what you need to understand. This is the simple moving average, SMA. Let's go to another example, because there are multiple. You could set the 200 moving average and have that red one up. You could also set another one and have a 50 simple moving average, right? So when the simple moving average, the longer one, is less reactive. So 200, notice that if the stock price goes down a lot and then it comes up a lot, the 200 moving average is taking into account the last 200 periods and then dividing them up, so then it can spit out a number and then give you a smooth line like this. But you can see that the 50, which is in blue, is reacting much more quickly than the 200. Now imagine if it was a 5 moving average or something like that. It would be even tighter onto the candles. Why? Because it would be accounting for just 5 periods instead of 50 periods, or instead of 100 or 200 periods. The longer the amount of time, or the length of your candles or your moving average, then the less reactive it's going to be, right? So I'll just say that again quickly. So the longer the period of time, so this one is 200 periods, this one is 50 periods, then the less reactive it is, right? So if we had a 15 moving average in here, it would be even tighter with the candles than the 200 or the 50. Now let's keep it going, and let's go to the setup. I want you to be able to set your account up like you see mine when we do the lives, right? So download WeBull. The link is in the description as well, next to the Moomoo link, and you're going to download and go to the desktop. Go to the desktop website after you made an account. You're going to hit download. Figure out which type of software or hardware you have. Do you have Windows? Do you have a Mac? Whatever you have, and then download that version of it. And then once you get on there, you'll see that there's charts. Once you get to the charts, once you download it and everything like that, what's important to see is the indicator button in green. You're going to see the moving averages. This is the SMA, the simple moving average. And then over here, you're going to see the EMA. But for now, let's talk about the SMA, or as it's written here, the MA, moving average. And let's go and check them out. When you see the moving average, you'll see that I have a green line, I have a orangish yellow line, and then I have a red line. Now notice, these are the 15 moving average. So moving average 15. We have the moving average 50, and then we have the moving average 200. So the moving average 15, notice that it's a smaller number than the others, the 50 and then 200. So this one is going to stay much more tightly with the candles than the others. It's going to be much more reactive than the others. Now, look at the middle one, which is the 50, and let's follow this arrow down, and you'll see that this one is more reactive to the candles than the 200, but the 200 is the absolute least reactive. So what do I mean by reactive? I mean this. What if the stock price shoots up? Take a look. The 15 moving average is trying to shoot up with it. What if the stock price shoots up and we look at the 50 moving average? We'll see that the stock price, you know what? The moving average starts to go up, but it doesn't go up as sharply and as quickly and as reactively, if that's a word, to or as the 50. Look at the 200. This thing is going up, but it barely even moved when the stock price shot up, because the 200 moving average is kind of telling you the overall picture. And you can always imagine that the 200 moving average is kind of like a magnet, and then the stock price likes to go right back towards it. If it goes under it, it'll like to come back eventually. And if it goes basically above it, it'll like to come back down to it eventually. You can think of it just like that. And it's an indicator. It's not a crystal ball. Remember that. So let's check this out. Once you get to there and you go to moving average, what you're going to do now is, and let's just step back for a second. You click moving average. That's this. And then you're going to see these things pop up, right? These lines. And if they don't pop up, what I want you to do is click this button right here called MA. You're going to go in here. You're going to set your lengths. I'm on moving average. My lengths are 15, 50, and 200. And if you go to style, you can change your colors. I changed my style to the 15 being green, this one being like an orange yellow, and then the 200 being red. So let's come back out of here after you can see how to set that up. And let's move on to now the next step. Let's talk about the simple moving average. Now, the simple moving average, aka the SMA, is defined as this. And what does it do? It calculates the average price of a selected range of prices, right? So you select 200 periods, you select 50 periods, you select basically however many periods, 15, and it gives you an average price of that range. So then let's go and see an example. When we look back here, right, our 15, our 50, and our 200, you'll see that if we look at the 15, the average range of prices, right, basically if you look at it over here, is basically 162. We have the average range of the last 50, it was 168. The average range of the last 200 is 153. So we can see the averages, and we can see how they move as new candles are made, right? So now let's keep it going now that we see what those things are. And let's go to the exponential moving average. This is the one that you really have to pay attention to in order to trade using the 1348 exponential moving average technique. Now, exponential moving average is very similar to the simple moving average, except it takes into account the newer candles and it weighs it way heavier than older candles. So with the simple moving average, every candle, let's say we're looking at the 200 MA, the 200 SMA, every single candle is weighed the same. But let's say that we're looking at the 200 EMA, for example, then the first few, they're not weighed as heavy as the last few. The ones that are more recent are weighed much more heavy into the calculation, and it can give you an earlier signal oftentimes. So this is why people use the EMA a lot of the time when they're trying to trade. So then let's take a look at the definition. EMA is similar to SMA. However, EMA applies more weight to new price movements than it does to old price movements. The SMA has them both weighed the same. All of the candles are basically weighed the same in the SMA, but in the EMA, the newer candles are weighed heavier than older candles. Okay, now that we have that out of the way, let's go to some trading pro tips. So how to trade moving averages. Now we're going to look at the 1348 EMA cross that has been popularized all over Twitter, YouTube, and everything like that. And let's talk about it. Now let's take a look. Let's look at the rules and the guidelines. So when you go to your indicator settings, right? Notice we're on EMA, on our indicator settings. I have it set to 13. Before I had it on 15. Now I have it on 13. I have it on 48. Before I had it on 50. Now I have it on 48. So I have 1348. And then I have my 200 in there as well. Right? And this is the EMA, not the SMA. Now, this is the point where I'm going to show you how to trade with it. Okay. You got to know. You got to focus on the 5-minute candles or greater to avoid getting faked out. Right? You can get faked out and get false signals, false breakdowns, false breakouts like we talked about in lesson 1. To avoid that from happening as regularly, it will happen with any indicator. You're going to get false signals. It's just the way of the market. It's just the way that it works. Now, check this out. Try to avoid the 1 minute. Because there's a lot of noise there. Stick to the 5-minute, the 30-minute, the 1 hour, and so on and so forth, right? So, for example, if you want to trade in one day and a get in and get out, you might want to use the 5-minute or the 30. If you want to trade basically and hold it for like overnight or hold it for 1 week, you might want to use basically the day chart or even the 4-hour chart. If you want to use it and hold an option for like a month, definitely use the day chart and maybe a little bit longer than that, but definitely use the day time frame. Right? So those are the time frames. Remember those, or play this part back if you need to get an idea as to how long do I want to hold on to this option, and then start playing the patterns with specific time frames. Again, you want to play it in the day, we're going to use the 5-minute, for example, or even the 30-minute, but generally the 5-minute if you want to get in one day and hold it for the day and get out in the same day. Now, let's check this out. How to enter a call using the 1348 strategy. Now, remember, these are indicators, not crystal balls. You trade with the chart, not with your heart. So, the 13 EMA crossing above the 48 EMA is a potential signal to buy a call. So, we look at the 13 EMA, our green line, and we see it cross above our 48 EMA, which is our orange line. This is a signal right here to jump into a call. Right? So you jump into a call and then you ride this wave. Whoa, look at that. It worked. It worked out in this case and you didn't get faked out. It worked out. So now that's how you enter a call using the 1348 EMA. It's actually quite simple, right? Let's go to how to enter a put. It's literally the opposite. So we have our 13 EMA over here, this green arrow. We have our 48 EMA, which is basically pointed at by this orange one. Now look at this. Look at this green line, our 13. Keep your eye on the green line. Remember, if you're trading like this, you have to make sure that you set these colors to something that you're going to remember. So in our case, we have the 13 green. This is what I keep my eye on. And if I see it cross under the 48 and I'm on the 5-minute time frame, I'm trying to trade it today, or if I'm on the week time frame or the daily time frame and I want to trade it out for a month or out for a week, remember, trade it off of the charts, not your heart. I see that here it says the 13 EMA crossing below the 48 EMA is a potential signal to buy a put. So we have our 13, we're watching it, and then we cross under the 48. This is a put signal. Boom, right? You get into a put when you see it cross, and then you ride the wave all the way down. Ride the wave, ride the wave, ride the wave. Now we're going to talk about potential signals that are a signal to get out of the play that you got in. Now I do want to also mention, notice to get some confirmation on your signal, if you are trading under the 200 EMA, in this case, okay, great. Then you might be able to say, this is a sign that this is showing weakness and I can get into a put. And we are trading under the 200 EMA and the 13 crossed over or under the 48. So then this is basically two confirmations in one, right? We got the 1348 cross, and then we're trading under the 200 EMA. So this is a sign that this thing is going to drop. Now let's get into how to get out of a play when you're trading with the chart, not with your heart. You just want to use a system. So take a look at this. We have our 13. Let's say that you were riding in a put option. You get a signal to enter the put because the 13 goes under the 48. We're still over the 200 red moving average. So this is not the best signal, but there is a signal there to tell you to get into a put. There's some money to be made. There's one signal, not the two. So now check this out. And by one, not two, I mean we got the one signal with the cross. The second signal would have been we were trading under here, but we're not. We only have the one. So now, and by under here, I mean under the 200 moving average. So now check this out. When the 13 crosses under the 48, you get into a put in this example. And you're riding it, riding a wave, riding a wave, riding a wave. You go down here, you start to see it kind of bottom out a little bit, right? You start to see almost a bottom and then almost a double bottom forming. But you know what? Your signal to get out using the EMAs is actually here. And what is that? This is when the stocks start to touch the 48. They're touching the 48. This is a signal. You know what? You could get a false signal to get out. Maybe it'll keep dropping, but this is the signal to tell you to exit the put. And in this case, you would have exited the put. You would have entered it here at the cross, exited here when it hit the 48. And then, you know what? You got out on time because it rocketed up after that, right? And then you can see again in the aftermarket hours in this kind of gray spot, you can see the 13 cross back above the 48 and then another rocket, right? So then that's how that works. So what I want you to do now that you know how to trade with the 1348 cross is watch this part over again, and maybe you have to watch this video twice and get ready for the quiz. It's coming out soon. And again, get into the class questions if you have any questions. This is right under the technical analysis class and options class in the Discord. Get in there, and I appreciate y'all. I love y'all. I want you to understand a sign of strength, like you see on the watch list, is the 13 crossing above the 48, especially when they're over the 200. A sign of weakness is when you see the 13 cross below the 48 EMA, and especially when they're below the 200 EMA, right? So then I want you to think of them just like that when you see on the watch list strength or weakness above a certain or below a certain point that I post basically every day, right? When you look at the watch list, you can use the EMA as strength. You can also throw in the MACD and then use both of these things as strength or weakness. And again, family, I love y'all. I appreciate y'all, and I got you. I always want to bring value to you and give you a new tool in your toolbox. But you already know, if you can't handle the heat of these hot stocks, then stay out of the kitchen and consider investing in index funds. Family, I love y'all. Take care.